are at assignment 4.1 handout, and there's all blanks there. So I guess we better start answering some questions, or help you answer some questions. You may hear my puppy in the background barking. I apologize for that. Explain why the following accounts are being adjusted. I know your adjustments have probably been a wee bit confusing, so let me see if I can help you understand this. They have prepaid rent. Why would I have to adjust prepaid rent? Well, for one reason, I prepaid it, so I haven't expensed any of it. A month has gone by, and I've used a month of that rent. And because of the matching principle, we have to match expenses to the period in which they're incurred, as well as revenues to the period that they are incurred. And that's what we're doing. We're adjusting all of the funds that are out there that have not been recorded. So what we need to do is figure out how much rent has been used, and then record that as an expense and remove some of it from the prepaid rent as an asset. Unearned service revenue. That means somebody has given us, if you're a lawyer, somebody will give you a retainer, and they may give you a retainer for the full year. Well, each month you're going to assign some of that unearned revenue to match it with the period and the expenses, so that you've pulled that together. So you would reduce your unearned service revenue and increase your service revenue with an entry. This next one was supplies. A lot of people buy supplies in bulk and have an inventory. So they will go out and count that inventory each month to see how many supplies they've used. And this is a way to write that into the expenses. So you would decrease the supplies, and you would increase the supplies expense. And the other one is salaries payable, and you go, what are they talking about? Well, nobody, it's very seldom that your payroll ends on the last day of the month. So you may have salaries or wages that have been accrued that have not been recorded. So you would record that as a salaries expense and a salaries payable for when it's paid. So when you pay it, then that would come out of the salaries payable. The other one is depreciation expense, and that's fairly easy to understand. You create an asset, and it's a long-term asset, and then you depreciate it out over its lifetime. So each month, as you close the books, you're going to look at that and say, okay, let's say I'm depreciating $12,000 a year, straight line for 5 years. That means for each month, there's $1,000 worth of depreciation that should be charged to the expense account. So you're bringing, you're bringing all of the funds and all of the accounts that are on the chart of accounts in the general ledger. You're bringing them to align them with revenues and expenses for the period. So you've got the revenues, you're pulling the expenses in for that period. So that kind of explains why you're doing the adjustments. For 2, right here, another blank. For 2, that's fairly easy. You can get that out of the book. They're just asking you what the terms mean. So you can carry on with that. For 3, they ask you questions about normal balance. And this is really a good activity because it helps you kind of understand what happens with retained earnings and the income statement, and all of the accounts that are in the income statement. So if you really sit down and think about this, draw out a picture. What account on the income statement has the same normal balance as the retained earnings? Well, retained earnings are an equity, and their balance is credit, right? It's on the right-hand side of the equation, so that is the credit side. So now, what account on the income statement is the same balance as the retained earnings. And you'll come up with revenues, correct? So those two kind of go hand in hand. Now, who's the opposite? That would be the expenses, because they're a debit balance, because they will subtract from revenues. So play with that so you can kind of wrap around that in your head. Now, if we go down to 4, 4 is asking you to journalize closing entries. And this is the glory of accounting. It's such a beautiful puzzle when it all goes together. So to get the retained earnings correct, you have to net all of the accounts that make up retained earnings, and that would be revenues, expenses, dividends, and net income ends up getting dumped into revenue, and that's done with the closing entries. So your closing entries look like, what were your dividends? Your dividends have a debit balance, and you need to make that account 0. So you would credit it for the amount of the dividends, and you would debit retained earnings. What is that going to do? That's going to subtract from it, because you've paid out you've paid out dividends to the stockholders, and that has to come out of retained earnings. Now you look at your service revenues, and that needs to be a 0 balance. So what would I do with my service? As you're looking at that, what kind of balance does it have? What kind of balance does that service have? That service has a credit balance, right? So I need to debit it. And that means I have to credit the income summary. Now let's turn around and look at the salaries, the rent, and the advertising. Those all have debit balances, so they'll have to be credited, and the income summary debited. Now you're going to look at this in a T account, and the difference here in the income summary gets put into retained earnings. So it makes everything nice and neat. Those all go into the balance sheet and the retained earnings, and all of your temporary accounts are then 0. So that concludes the first page. We'll come back and do page 2 in just a second. Thank you.